There's a lie that lives at the heart of the modern financial world. It's a seductive, comforting lie, whispered on financial news networks, splashed across corporate press releases, and championed by chief executives in slick annual reports. It's a lie that has built empires of sand and evaporated the life savings of millions. The lie is this: that growth is always good, that a bigger company is a better company, that rising revenues are the undeniable sign of a healthy, thriving enterprise that is making its owners richer. We are conditioned from a young age to believe that bigger is better. A bigger house, a bigger salary, a bigger business. Growth is progress. Growth is success. And so, we hunt for it. The retail investor, the person trying to build a nest egg to achieve some measure of financial freedom, is told to find the companies with the most explosive growth. Sales up 20%, 30%, 50% year over year. This, they are told, is the rocket fuel of portfolio growth. This is how you generate life-changing capital gains. But what if the rocket is flying straight into the ground? What if the fuel being burned is your own money, your own capital, being incinerated in the pursuit of a bigger but ultimately less valuable enterprise? Consider for a moment the brutal, simple math of value. If you give me $1, and I, through my skill and effort, turn it into $1.20 for you, I have created value. You are richer. But if you give me $1, and I, in my frantic pursuit of growth, spend it to build a machine that generates only 80 cents of value, I have not created anything. I have destroyed your capital. The business might be bigger. It might have a new factory, more employees, more headlines. But you, the owner, are poorer. This is the poison hiding in plain sight within the stock market. Countless companies, year after year, engage in this exact act of value destruction. They grow, but they do so unprofitably. Not unprofitably in the sense of net income, which can be manipulated and massaged, but unprofitably in the most fundamental way imaginable. They invest capital at rates of return below their cost of that capital. They are spending $1 to make 80 cents, and they are doing it with your money. This brings us to one of the most profound and devastating stories in the history of American capitalism. A story of breathtaking growth, technological marvel, and financial ruin. The story of the airline industry. From the moment Orville and Wilbur Wright's fragile contraption first lifted off the sands of Kitty Hawk in 1903, the industry was destined for explosive growth. It captured the imagination of the world. In the decades that followed, it connected cities, shrank the globe, and became a symbol of modern progress. The growth was undeniable, from a few brave passengers to hundreds of millions per year. From rickety biplanes to continent-spanning jetliners, revenue grew at a staggering pace. The industry got bigger and bigger and bigger. If you had been an investor in the 1950s or 60s, looking at the charts of passenger miles flown, you would have thought you'd found the surest path to wealth in human history. Yet Warren Buffett, a man whose entire career is a testament to sidestepping popular delusion, once quipped that if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a great service by shooting Orville down. Why such a cynical, brutal assessment of an industry that changed the world? Because Buffett wasn't looking at the romance of flight or the charts of soaring revenue. He was looking at the graveyard of capital that lay beneath it. For nearly its entire history, from 1903 through the end of the 20th century, the cumulative earnings of the entire U.S. airline industry were less than zero. Let that sink in. Decades of mind-boggling growth, trillions of dollars in revenue, and the net result for the owners of these businesses was a loss. Trillions of dollars of investor capital had been poured into shiny new airplanes, sophisticated booking systems, and expensive airport gates, only to be vaporized in the crucible of ferocious competition. Every dollar invested in a new Boeing 747 did not generate $1.20 of value. It generated 80 cents, or 70, or 60. The growth was a mirage. It was profitless prosperity. To get bigger, the airlines had to constantly spend enormous sums of money on planes that were expensive to buy and even more expensive to maintain. They were locked in brutal price wars where the only winner was the consumer who got a cheap ticket from New York to Los Angeles. Labor unions demanded and received massive contracts that bled profits dry. Every time one airline gained a slight edge, a dozen competitors would rush in, slashing prices and destroying any hope of a decent return. They were running on a treadmill, spending billions just to stay in the same place. The owners of these businesses, the shareholders, were the ones paying for the fuel. They were funding the growth that was making them poorer with every new plane that rolled off the tarmac. The lesson of the airline industry is a chilling one. It is the perfect, large-scale embodiment of the great lie. It proves that growth in and of itself is not just meaningless. It can be a weapon of mass financial destruction. It reveals a fundamental truth that the 99% of investors never grasp. The headline number, the revenue growth, the story of expansion, that is the numerator. It's the exciting, visible part of the equation. But the secret to wealth, the key to avoiding the airline trap, lies in understanding the denominator, the amount of capital it takes to produce that growth. This deep-seated human desire to see things get bigger, to be a part of an expanding enterprise, is a powerful psychological force. It's what we can call the growth bias. It's an offshoot of our natural action bias. We believe that activity and expansion are inherently better than stillness and stability. A company that is aggressively hiring, opening new offices, and launching new products feels dynamic and successful. A company that is quietly sitting on its established market, generating cash without much fanfare, can feel stagnant and boring. We are drawn to narratives, and the story of growth is the most compelling business narrative there is. A visionary CEO, a disruptive technology, a product taking the world by storm. These stories are intoxicating. They trigger the same parts of our brain that respond to epic tales of conquest and exploration. The financial media feeds this bias constantly, celebrating companies that post the highest quarterly revenue growth and lionizing the CEOs who pursue aggressive land grab strategies. We fall for the narrative fallacy, a term coined by Nassim Taleb, where we are swayed by a good story, regardless of the underlying facts and data. The story of a company growing its footprint by 50% is far more compelling than the story of a company maintaining a 25% return on its existing capital base. One sounds like progress, the other sounds like accounting jargon. This bias leads us to chase the wrong metrics. We look at the income statement, we see revenues climbing, and we get excited. But we ignore the balance sheet and the cash flow statement, where the true cost of that growth is hidden. To counteract this powerful psychological pull, we need a mental model, a blueprint for thinking that forces us to ask the hard, unpopular questions. We need to install a capital hurdle rate framework in our minds. It's a simple, yet profoundly effective way to begin piercing the illusion of growth. It's the first step an aspiring retail investor can take to move from being a story follower to a business analyst. The process is straightforward. First, identify the company's reported growth rate. This is the easy part. It's the number they plaster all over their investor presentations. Sales are up 20%. Great. Now, the real work begins. Second, you must become a financial detective and find the cost of that growth. Go to the company's cash flow statement, a document far more honest than the income statement. Look for a line item called capital expenditures or purchase of property, plant, and equipment. This number tells you how much cold, hard cash the company had to spend on things like factories, machines, and technology just to support its operations and, presumably, its growth. Third, you need to estimate their cost of capital. This sounds complicated, but for our purposes, we can simplify it. A company raises money in two ways: by taking on debt, borrowing from a bank, or by issuing equity, selling ownership stakes to investors. The cost of capital is a blend of the interest rate on its debt and the return that its equity investors expect. A reasonable, conservative estimate for most established companies might be somewhere between 8% and 12%. This is the hurdle. It's the minimum return the company must earn on its new investments to avoid destroying value. Finally, you ask the killer question, the one that separates the intelligent investor from the speculator. Is the return the company is generating on all that new capital expenditure higher than this hurdle rate? If a company spends $1 billion on new factories, capital expenditures, to generate an extra $80 million in profit, that's an 8% return on that new investment. If its cost of capital is 10%, it has just engaged in a massive act of value destruction. The company got bigger, its revenues went up, but it made its owners poorer because they could have taken that $1 billion, put it elsewhere for a 10% return, and been better off. The company failed to clear the hurdle. This simple framework forces you to connect the growth on the income statement with the cost on the cash flow statement. It's the antidote to the growth bias. It forces you to think not like a fan of the company's story, but like the owner of the business, vigilantly questioning whether your managers are being good stewards of your capital. The path of the 99% of investors is to do the exact opposite. They are moths drawn to the flame of a dramatic growth story. They chase headlines. They log into their brokerage accounts and buy a stock because a news anchor excitedly announced that the company's sales were up 30% last quarter. They don't ask how that growth was achieved. They don't look at the debt taken on, the shares issued, or the billions in capital spent to acquire those new customers. They just buy the story. Let's take the dot-com bubble of the late 1990s as a perfect case study. Companies like Webvan or Pets.com were reporting astronomical revenue growth. They were darlings of the media. Their stock prices soared to unbelievable heights. The 99% piled in, convinced they were investing in the future. But if you had applied the capital hurdle rate framework, you would have seen the disaster coming from a mile away. These companies were spending hundreds of millions, sometimes billions of dollars on warehouses, delivery trucks, and Super Bowl ads to achieve that growth. Their capital expenditures were monumental, and the return on that capital? It was deeply, horrifically negative. They were spending $1 to acquire a customer who would only ever generate 30 cents in profit over their lifetime. They weren't just failing to clear an 8% hurdle rate, they were actively incinerating cash with every new sale. The growth was not just unprofitable, it was a death spiral. When the capital markets finally turned off the spigot of easy money, these companies collapsed overnight, taking the portfolios of those headline chasers with them. The people who bought the story were wiped out. The people who questioned the economics of the growth were safe on the sidelines. This isn't just a historical artifact. It happens in every market cycle with different industries: biotech, cannabis, electric vehicles, AI. A hot new trend emerges. A few companies show explosive revenue growth, and the 99% flock to them, ignoring the catastrophic unit economics and the mountains of capital being burned. They always forget the lesson of the airlines. Growth without profit is a vanity that the shareholder ultimately pays for. Let's make this tangible. Imagine two companies, let's call them Growth Co. and Quality Co. Both start with a market value of $1 billion. In year one, Growth Co.'s CEO, chasing a massive bonus tied to revenue, decides to grow at all costs. He announces a plan to double sales in 1 year. To do this, he takes on $800 million in new debt and spends it all on new facilities and a massive marketing blitz. At the end of the year, he succeeds. Revenues have doubled. The headlines are fantastic, but the interest on that new debt eats up most of the new profit, and the return on that huge $800 million investment is a measly 3%. The company is now much bigger, but its balance sheet is crippled with debt, and its ability to generate profits relative to its massive new size is worse than before. The stock languishes, and eventually, as the weight of the debt becomes apparent, it falls. The pursuit of growth has destroyed shareholder value. Now consider Quality Co. Its CEO ignores the siren song of growth for growth's sake. Their goal is profitable growth. They tell shareholders they expect to grow revenues by a modest 7% for the year. But they have a strict rule. They will only invest in projects that they believe will generate a return of 15% or more, well above their cost of capital. They find only $50 million of such projects. They invest that money wisely. The rest of the profit the company generates, a sizable sum, is returned to shareholders through dividends and stock buybacks. At the end of the year, the company is only slightly larger. There are no splashy headlines. But the profits per share have soared because of the buybacks. The balance sheet is pristine. The business is a more efficient, more profitable machine than it was a year ago. Its stock price doesn't just go up. It begins to compound steadily, year after year. The owners of Quality Co. are getting rich, quietly and consistently. The owners of Growth Co. are holding a bigger, but ultimately worthless, piece of paper. This is the fundamental choice in investing. Are you betting on the illusion of size or the reality of profitability? The number that allows us to distinguish between the two, the number that acts as an X-ray into the financial soul of a company, is the single most important metric in any serious financial analysis. It's the number that would have saved you from the airline trap, the dot-com bust, and every value-destroying empire builder in between. It is the oracle's lens. Warren Buffett and his partner Charlie Munger have built Berkshire Hathaway into a $500 billion fortress on a foundation of a few simple, powerful ideas. They are not traders. They are business owners who buy pieces of companies with the intention of holding them forever. And to decide which businesses are worthy of that permanent place in their portfolio, they don't start with stock charts or macroeconomic forecasts. They start by judging the fundamental quality of the business itself. And the primary measure of that quality, the lens through which they view every potential acquisition, is a concept they learned and perfected over decades: return on invested capital, or ROIC. Their 1972 purchase of a small, family-owned chocolate company called See's Candies is perhaps the most important transaction in their storied career, not because of its size, but because of the profound lesson it taught them about the power of this single number. At the time, Buffett and Munger were still operating under the influence of their mentor, Ben Graham, the father of value investing. Graham's method was to find cigar-butt companies, mediocre businesses trading at statistically dirt-cheap prices. You'd buy them, hope for one last puff of profit, and then discard them. But Munger, in particular, was pushing Buffett to evolve. It's far better, Munger would say, to buy a wonderful company at a fair price than a fair company at a wonderful price. See's Candies would become the living embodiment of that philosophy. The company was being sold by the See family for $30 million. It was earning about $4 million a year before taxes. Buffett, still a Graham disciple at heart, initially balked at the price. Paying a multiple of 7.5 times pre-tax earnings seemed too rich. His cigar-butt instinct screamed that it was too expensive. But Munger and another associate pushed him. They saw something deeper. They saw a wonderful business. They analyzed the numbers. They saw a company with a beloved brand, a loyal customer base, and pricing power. But the secret sauce, the economic magic of See's Candies, was its phenomenal return on invested capital. To understand this, you have to look at what it took to run and grow the business. See's sold chocolates through its own retail stores. The magic was that customers paid for the product in cash, up front. But See's didn't have to pay its suppliers for sugar, chocolate, and other ingredients for 30 or 60 days. This created something called float. The company was essentially being funded by its customers and suppliers. It needed very little of its own capital tied up in inventory or receivables. The stores themselves were simple and didn't require massive ongoing investment. The result was a business that could generate its $4 million in earnings with only about $8 million of tangible capital invested in the business, things like stores and candy-making equipment. That's a pre-tax return on capital of 50%. Buffett and Munger, after some negotiation, bought the company for $25 million. This is where the story gets truly extraordinary. Because of its high ROIC, See's didn't need to retain its earnings to grow. It could grow its sales modestly each year by opening a few new stores and raising prices slightly, and it could fund this growth with a tiny fraction of its profits. The rest of the profit, a gushing river of cash, could be sent back to headquarters at Berkshire Hathaway in Omaha. Over the years, that initial $25 million investment has returned directly to Berkshire more than $2 billion in cash. $2 billion. And Berkshire still owns the business, which continues to be profitable. See's Candies became Buffett's prototype for the perfect business, one that earns a very high rate of return on the capital it employs and can grow while distributing most of its earnings to its owners. It was the polar opposite of the airline industry, which also required capital but earned a miserable return on it. See's required very little capital and earned a fabulous return. That is the essence of ROIC. It taught Buffett and Munger that the real game wasn't just finding cheap assets. It was finding these incredible economic engines that could produce cash far in excess of their needs, creating a surplus that a skilled capital allocator could then deploy elsewhere. The psychological principle at play here is a subtle but powerful one. Most people, when they look at a business, fall prey to a cognitive shortcut called mental accounting. They lump everything together. They see a company as one monolithic entity that makes money. They look at the bottom line, net income, and see a single number that represents success. ROIC forces you to break this mental model. It insists that you perform a mental separation. You must view the business as two distinct parts: the operations, which is the engine that generates the profit, and the invested capital, which is the pile of money that was used to build and fuel the engine. ROIC is the ratio between these two. It answers the question, for every dollar of capital we've entrusted to this management team, how many cents of profit are they generating for us each year? It shifts the frame of the question from the simplistic, how much did it make, to the far more insightful, how much did it make relative to what was put in? This is a profoundly different way of thinking. It protects you from the availability heuristic, another cognitive bias where we give undue weight to information that is easily accessible. The earnings per share number is everywhere. It's in every headline, every analyst report. It's easy to find. The invested capital figure? That requires you to open up the annual report, to dig into the balance sheet, to do a little bit of work. Because it's less available, most investors ignore it. They focus on the numerator, the earnings, and completely disregard the denominator, the capital. A company can easily grow its earnings by simply taking on a massive amount of debt and buying another company. The earnings will go up, the headlines will look good. But if the return on that new capital is poor, the ROIC of the combined company will fall, and long-term value will have been destroyed. The investor who only looks at earnings is fooled. The investor who calculates ROIC sees the truth. So how do we, as retail investors without a team of analysts, calculate this magic number? It's less intimidating than it sounds. It's a blueprint, a repeatable process for peering into a company's financial soul. It has 3 steps. The first step is to find the numerator, the true operating profit of the business. We call this NOPAT, or net operating profit after tax. You start on the income statement. Find the line called operating income, or EBIT, which stands for earnings before interest and taxes. This is a crucial starting point because it represents the profit from the core business operations, before the effects of how the company is financed, i.e., how much debt it has. We want to analyze the business, not its capital structure at this stage. Then, we need to account for taxes. You can find the company's effective tax rate in its filings. Let's say it's 25%. You then calculate NOPAT as EBIT multiplied by 1 tax rate. So if EBIT is $100 and the tax rate is 25%, your NOPAT is $75. This is the after-tax profit generated by the core business for all capital providers, both debt and equity holders. The second step is to find the denominator, the invested capital. This is the total amount of money from all sources that the company has used to build its operating assets. You find this on the balance sheet. There are 2 ways to calculate it, which should give you roughly the same number. The first is the operating approach. You take total assets and subtract out any non-interest-bearing current liabilities. These are things like accounts payable or accrued expenses, essentially free financing the company gets from its suppliers and employees. You subtract this because it's not capital that investors had to provide. The second way is the financing approach. You add up all the company's debt, both short-term and long-term, and all of its shareholders' equity. This represents all the money provided by lenders and owners. From this sum, you subtract any cash that is not essential for the company's day-to-day operations, as excess cash isn't really invested in the business. For most investors, the financing approach, debt plus equity excess cash, is often a bit more straightforward. The third and final step is the calculation itself. You simply divide the numerator by the denominator. ROIC equals NOPAT divided by invested capital. If our company had a NOPAT of $75 and an invested capital of $500, its ROIC would be 15%. This number, 15%, is the output. It is the measure of the business's efficiency at turning money into more money, but a number in isolation is meaningless. To give it context, we compare it to the company's weighted average cost of capital, or WACC. As we discussed earlier, this is the blended cost of its financing, typically between 8% and 12%. If ROIC is greater than WACC, the company is creating value with every investment it makes. If our company's ROIC is 15% and its WACC is 10%, it is a value-creating machine. If its ROIC were 7%, below its WACC of 10%, it would be a value destroyer, slowly liquidating itself even if it's reporting positive earnings. The antithesis of this approach, the path of the 99%, is to fixate on other, more superficial metrics, most notably the price-to-earnings PE ratio. The PE ratio is the siren song for amateur value investors. They are taught to look for companies with low PE ratios, thinking they've found a bargain. But a low PE ratio can be a lethal trap if the company in question is a low ROIC business. Consider a typical old-line industrial company, like a steel mill. It might trade at a PE of 8, which looks incredibly cheap compared to the market average of 20. The retail investor gets excited. "A bargain!" they exclaim. But why is it so cheap? Because the market, in its collective wisdom, understands the brutal economics of the steel business. To make steel, you need gigantic, fantastically expensive blast furnaces. These furnaces wear out and need constant, massive capital investment just to maintain the current level of production. So while the steel mill might report a positive net income, giving it that low PE ratio, a look at its cash flow statement would reveal that all of that income, and maybe more, has to be immediately plowed back into the business in the form of capital expenditures. It's a business that can never truly gush cash for its owners. Its return on invested capital is chronically low, often below its cost of capital. It's running on a capital-intensive treadmill to nowhere. The E in the PE ratio is an illusion because it can never be returned to the owners. It's trapped in the business forever. The low PE isn't a bargain, it's a warning sign. It's the market's way of saying, yes, this business earns a profit, but it's a terrible business that will never make its owners truly rich. The investor focused on ROIC would see this immediately. They would see the enormous invested capital base and the mediocre profits and move on, leaving the cigar butt for someone else to smoke. Let's put this into a direct financial connection. Picture two companies. Software Co. has a brilliant piece of code that it sells on a subscription basis. It took $100 million to develop the software, so that's its invested capital. It generates $30 million a year in after-tax operating profit, NOPAT. Its ROIC is a spectacular 30%. Because the software is digital, it requires almost no new capital to grow. It can add 1,000 new customers, and its costs barely budge. Now picture Utility Co. It's a regulated power company. It required $2 billion in invested capital to build all its power plants and transmission lines. It generates $160 million a year in NOPAT. Its ROIC is 8%. It's a stable, predictable business, but it's a capital hog. And because its returns are regulated by the government, it can never earn much more than its cost of capital, which might also be around 8%. Over the next 10 years, what happens? Software Co., with its 30% ROIC, needs to reinvest almost nothing to maintain its business. It can take nearly all of its profits, that $30 million per year, and use it for other things. It could pay a massive dividend to its owners. It could buy back its own shares, making each remaining share more valuable. Or it could invest in developing a new software product that could also earn a 30% return. Any of these choices creates enormous value for shareholders. Utility Co., on the other hand, with its 8% ROIC, is a different story. Much of its $160 million in profit has to be reinvested into maintaining its aging infrastructure. There is very little free cash flow left over for the owners. It can't dramatically grow its earnings because its returns are capped. Its stock price will likely tread water for a decade. The owners of Software Co. will see their initial investment compound at a breathtaking rate, achieving true portfolio growth and financial freedom. The owners of Utility Co. will earn a modest dividend and little else. Both companies were profitable. But one was a wealth creation machine, and the other was a capital trap. ROIC was the number that told you the difference. In the year 2000, at the absolute zenith of the dot-com bubble, two titans of American industry decided to merge. One was AOL, America Online, the king of the new digital world. It was the gateway to the internet for millions, a company with a soaring stock price and the swagger of a revolutionary. The other was Time Warner, the venerable old media giant, owner of CNN, Time Magazine, Warner Brothers Studios, and HBO. It was a sprawling empire of content and distribution. The deal was billed as the marriage of the century, a perfect fusion of new media technology and old media content. The CEO of AOL, Steve Case, and the CEO of Time Warner, Gerald Levin, stood on stage together, proclaiming the birth of a new kind of company that would dominate the global media landscape for generations. The market, at first, went wild. It was the ultimate growth story. The biggest media company in the world was about to get even bigger. This was empire building on a scale never before seen. But beneath the surface of this celebrated mega-merger lay the seeds of its own destruction. The deal was a monument to the hubris of its architects and a tragic case study in the psychology that drives corporations to pursue size over value. AOL, despite its high-flying stock, was a business with a questionable long-term future. Its core dial-up internet service was already being threatened by the rise of broadband. Time Warner was a collection of decent but largely mediocre return businesses. The synergies that were promised, the magical cost savings and revenue opportunities from combining the two, were largely a fantasy. The real driver of the deal was ego. It was the desire of the executives involved to preside over the largest, most powerful media conglomerate on the planet. It was a decision driven by the psychology of size. When the dust settled, the new company, AOL Time Warner, was a financial Frankenstein's monster. The combined entity had a balance sheet bloated with an astronomical amount of goodwill, an accounting term for the premium paid over the tangible value of the assets acquired. More importantly, the fundamental economics of the combined business were abysmal. The high-growth, high-margin dreams of AOL were now anchored to the slow-growth, capital-intensive reality of Time Warner's cable systems and magazine publishing. The overall return on invested capital of the new company was dreadful. The market, once the initial euphoria wore off and the grim reality of the numbers became clear, reacted with brutal efficiency. The stock price collapsed. The company was forced to take a write-down of nearly $100 billion, at the time the largest annual loss in U.S. corporate history. The merger that was supposed to define the future ended up being arguably the worst deal of all time. It was a story of how the relentless pursuit of growth and size divorced from the discipline of ROIC, could lead to a catastrophe of epic proportions, destroying hundreds of billions of dollars in shareholder wealth. The AOL Time Warner disaster is a powerful illustration of a fundamental conflict that exists at the heart of many public companies, the agency problem. In theory, the executives of a company, the agents, are supposed to act in the best interests of the company's owners, the principals or shareholders. In reality, their interests are often misaligned. A CEO's compensation is frequently tied to metrics like revenue growth, market share, or the sheer size of the company. A bigger empire often means a bigger salary, a bigger bonus, and more prestige for the person at the top. It feels good to run the biggest company in the industry, to be on the cover of magazines, to be celebrated as a bold visionary. Whether that size is actually creating per-share value for the owners can become a secondary concern. The executive is rewarded for growing the empire, even if that growth is unprofitable and destructive. They get the upside of the prestige and pay, while the shareholders bear the downside of the poor returns. This agency problem is supercharged by two powerful behavioral biases that afflict investors: social proof and herd behavior. When a company announces a big, splashy acquisition, the media covers it breathlessly. Analysts release glowing reports about the supposed synergies. Other investors start buying the stock, pushing the price up. The individual retail investor sees all this activity and thinks, well, if all these smart people are buying, it must be a good idea. This is social proof. They are substituting the judgment of the crowd for their own analysis. This leads to herd behavior, as everyone piles into the stock, creating a self-fulfilling prophecy where the price rises simply because people are buying. This temporary surge in the stock price seems to validate the CEO's decision, creating a dangerous feedback loop. The CEO who does the big deal is celebrated, while the CEO who patiently focuses on ROIC can be seen as timid or uninspired. The herd rewards the empire builder, at least for a little while. But like all decisions untethered from sound economics, the herd is eventually, and often painfully, proven wrong. The high from the acquisition fades, the promised benefits fail to materialize, the low ROIC reality sets in, and the stock comes crashing back to earth. To protect ourselves from being swept up in this destructive cycle, we need another mental model. This one is less about calculation and more about qualitative judgment. It's the scuttlebutt, or owner's mindset filter, a concept championed by the legendary investor Philip Fisher. It means going beyond the numbers and trying to understand the culture and motivations of the people running the company. It means asking, do these executives think like owners, or do they think like empire-building bureaucrats? The first step in applying this filter is to read the CEO's annual letter to shareholders. This is often the most revealing document a company produces. Is the CEO's letter filled with jargon and boasts about being number one in the market? Does it talk endlessly about revenue growth and new initiatives? Or does it speak in plain language about per-share value, return on invested capital, and the disciplined allocation of the owner's money? A CEO who obsesses over ROIC in their annual letter is a CEO whose interests are likely aligned with yours. A CEO who never mentions it is a massive red flag. Warren Buffett's letters for Berkshire Hathaway are the gold standard. They are masterclasses in owner-oriented thinking. Second, you must analyze the company's acquisition history. Don't just take their word for it that a deal was accretive. Look back at the acquisitions they've made over the past 5 or 10 years. How much did they pay? What did the acquired company's profits look like? Has the acquired business grown and prospered under its new ownership, or has it languished? A track record of consistently overpaying for mediocre businesses is a clear sign of an empire builder at the helm. A track record of small, bolt-on acquisitions bought at reasonable prices that clearly enhance the core business's moat is the sign of a disciplined capital allocator. Third, examine the executive compensation structure, which is detailed in the company's proxy statement. This can be tedious, but it's where the truth is revealed. Is the CEO's bonus tied to metrics that actually create shareholder value, like growth in ROIC or economic value added? Or is it tied to vanity metrics like revenue size, or worse, the stock price itself, which can encourage short-term gimmickry to pop the stock? If the incentive system rewards the wrong behavior, you can be almost certain that you will get the wrong behavior. By applying this owner's mindset filter, you start to see companies not as tickers on a screen, but as collections of people making decisions. And you can begin to separate the managers who are there to get rich chumps with you from the ones who are there to get rich chumps wish you from to wish you. The path of the 99% is to do the opposite of all this. They blindly trust visionary CEOs, especially those who are media darlings. They get swept up in the narrative. They hear about a big merger on the news, and their first thought isn't, "I wonder if this will generate a return above its cost of capital." It's, "Wow, this is exciting, maybe I should buy the stock." They confuse the drama of corporate activity with the creation of value. Let's trace the journey of a typical retail investor during the AOL Time Warner mania. They see Steve Case on the cover of a magazine, hailed as a genius. They watch analysts on TV talk about the unstoppable new media powerhouse. Their neighbor brags about how much money he's made on AOL stock. The social proof and herd instinct kick in. They log into their account and buy, feeling smart and plugged in. They don't read the annual report. They certainly don't try to calculate a pro forma ROIC for the combined company. They buy the story hook, line, and sinker. For a few weeks, maybe it works. The stock drifts up on the hype. But then, the first earnings report of the combined company comes out. The numbers are confusing and disappointing. The promised synergies aren't there. The stock drops 10%. The investor tells themselves it's just a blip. But then the next report is worse. The culture clash between the two companies is becoming public. Key executives are leaving. The stock drops another 20%. Soon, the narrative completely flips. The media that once celebrated the deal is now calling it a disaster. The visionary CEO is now labeled a fool. The herd, which was buying frantically a year ago, is now selling in a panic. Our retail investor who bought near the top finally sells in despair near the bottom, locking in a catastrophic loss to their retirement savings. They were a victim not of a bad market, but of a bad process. They followed the herd instead of the numbers. Let's model this financially to see the destruction in stark relief. Imagine a great company. Let's call it Innovate Corp. It has an ROIC of 25%. It's a fantastic business. The CEO, however, gets bitten by the empire-building bug. He decides to buy Legacy Corp., a large, boring company in a different industry with an ROIC of just 7%. Because Legacy Corp is so big, the deal is transformative. But to buy it, Innovate Corp has to pay a huge premium, loading up its balance sheet with debt and goodwill. Before the deal, Innovate Corp might have had $1 billion in invested capital, generating $250 million in NOPAT, a lean, mean, value-creating machine. After the deal, the new combined company might have $10 billion in invested capital, but a combined NOPAT of only $800 million. The new ROIC for the combined firm is now a pathetic 8%. The magic is gone. The high-return jewel has been diluted into a mediocre conglomerate. The company's ability to generate cash for its owners is crippled. Its debt payments are higher, its capital needs are greater, and its profitability is lower. The stock price will inevitably reflect this new, ugly reality. The CEO got his bigger empire. The shareholders got a much worse business. This is the direct financial consequence of ignoring ROIC in the pursuit of size. It is the path to diversification, a term the great fund manager Peter Lynch coined to describe diversification that, rather than reducing risk, actively destroys value by moving into businesses the company doesn't understand and that have poor economic characteristics. There exists a rare breed of executive, a stark contrast to the empire builders and diversifiers. They are the master capital allocators. These are the CEOs who see themselves not as managers of a specific operation, but as investors on behalf of their shareholders. Their primary job, as they see it, is to take the cash generated by the business and deploy it in the most intelligent way possible to maximize long-term per-share value. They are agnostic about how they do it. They might reinvest it back into the business, they might acquire another company, they might buy back their own stock, or they might simply return it to the shareholders as a dividend. Their only guide is the rational pursuit of the highest possible return on every dollar. The undisputed grand master of this art was a man named Henry Singleton, the founder and CEO of a conglomerate called Teledyne. His story is a powerful lesson in how an ROIC-driven mindset can be a decision engine for creating astonishing wealth. Singleton, a brilliant engineer and mathematician, built Teledyne from a small startup in the 1960s into a massive, sprawling conglomerate. On the surface, he looked like every other empire builder of his era, buying up hundreds of different companies in fields ranging from aerospace to insurance. But Singleton was playing a different game. His every move was dictated by a cold, hard, rational calculus of value. His capital allocation strategy had two distinct phases. In the first phase, during the 1960s, Teledyne's own stock traded at a very high valuation. Singleton astutely recognized that his own stock was an expensive currency. So, he used it. He went on an acquisition spree, but instead of paying cash, he used his high-priced stock to buy other, less expensive companies. He was essentially trading pieces of paper that he knew were overvalued for tangible, profitable businesses that he knew were undervalued. He was using the market's temporary mania to his shareholders' permanent advantage. Then, in the 1970s, the market mood shifted. The go-go years were over, and conglomerates fell out of favor. Teledyne's stock, along with those of its peers, fell to rock-bottom prices. It was trading for far less than Singleton believed its collection of businesses was intrinsically worth. So he completely reversed his strategy. He stopped making acquisitions. He saw that the best investment available in the entire market, the one with the highest potential return, was his own company. Teledyne began to use the massive cash flow its businesses were generating to aggressively buy back its own shares. Between 1972 and 1984, he bought back over 90% of Teledyne's outstanding stock. This had a stunning effect. The earnings of the company were now being divided among a much smaller number of shares. As a result, the earnings per share and consequently the stock price went ballistic. An investment of $1 in Teledyne during this period would have grown to over $100. Singleton demonstrated a profound understanding of capital allocation. He treated his own stock as just one of many potential investments. When it was expensive, he was a seller, by using it to buy other things. When it was cheap, he was a buyer. His guiding principle was always the same. Where can I deploy this next dollar of capital to get the highest possible return for my owners? He was a master, not because he was a brilliant operator of any single business, but because he was a brilliant allocator of the capital they all produced. The psychological principle underpinning Singleton's genius is the concept of opportunity cost. This is one of the most fundamental ideas in economics, yet it is consistently ignored in corporate boardrooms. Every dollar that a company decides to retain and reinvest in its own business has an invisible cost attached to it. That cost is the return that the shareholders could have earned if that dollar had been returned to them instead. If an investor can take $1 and earn a 10% return in a simple S&P 500 index fund, then any project the company invests in must have a prospective return of * more than 10% to be justified. If a CEO decides to invest that dollar into a new factory that will only generate a 6% return, they have destroyed value because their shareholders would have been better off getting the money back. A master capital allocator like Singleton lives and breathes opportunity cost. They are constantly scanning the horizon of all possible uses for $1, reinvesting in existing operations, making an acquisition, buying back stock, paying down debt, or paying a dividend, and choosing the one with the highest risk-adjusted return. This runs counter to another powerful bias called the endowment effect. This is our tendency to overvalue things that we own. For a CEO, this often manifests as falling in love with their own projects and divisions. They become emotionally attached to the business they built or the division they once ran, even if it has become a low-return, capital-intensive anchor on the rest of the company. A rational, singleton-esque allocator would look at that underperforming division, see that the capital trapped within it could be redeployed elsewhere for a much higher return, and would sell it without a second thought. But a CEO afflicted by the endowment effect will hang on, pouring good money after bad, unwilling to part with their division to the great detriment of the shareholders. This sophisticated thinking can be translated into a practical mental model for investors to use when analyzing a company's leadership. We can call it the capital allocation flowchart. It's a decision tree that a great CEO implicitly follows, and that you can use to judge their actions. First, the CEO must calculate the company's return on invested capital. Second, they must compare it to their weighted average cost of capital. If the ROIC is consistently and significantly higher than the WACC, they are running a value-creating business. Now the real choices begin. Are there reinvestment opportunities within the business that have a high probability of also earning returns greater than the WACC? If the answer is yes, this is the best possible scenario. The CEO should reinvest as much capital as possible for this kind of profitable growth. This is the dream of every investor, a company that can compound its own capital at a high rate. But what if the answer is no? What if the company is a wonderful, high ROIC business like See's Candies, but it has limited opportunities to reinvest its cash at similar high rates? Then the mandate is clear. The capital must be returned to the shareholders. Now a second choice arises: how to return it. The CEO must look at the valuation of their own stock. Is the stock trading at a price below their conservative estimate of its intrinsic value? If so, the best use of capital is to aggressively buy back shares. This is an act of anti-dilution, making each remaining shareholder's stake in the business larger and more valuable. If, however, the stock is trading at or above its intrinsic value, buying it back would be a poor use of capital. In that case, the money should be returned to shareholders in the form of a dividend, allowing them to reinvest it as they see fit. Or, the company can hold the cash and wait patiently for a disciplined acquisition opportunity to appear. On the other side of the flowchart, if the company's ROIC is asterisk below its WACC, the CEO is presiding over a value-destroying enterprise. The mandate here is not growth, but restructuring. They must either fix the operations to improve ROIC, sell off the underperforming assets, and return the cash to owners, or, in the worst case, liquidate the entire business to stop the bleeding. The antithesis of this disciplined process is embodied by two all too common CEO archetypes: the hoarder and the diversifier. The hoarder CEO is paralyzed by indecision. Their company generates cash, but they are too timid to make a bold move. They don't have good reinvestment opportunities, but they are also reluctant to give the money back to shareholders, perhaps because a larger cash balance makes them feel safer or more powerful. So, the cash piles up on the balance sheet, earning a pitiful return in short-term government bonds. This hoard of unproductive cash drags down the company's overall ROIC and represents a massive opportunity cost for shareholders. The diversifier CEO is the opposite. They are cursed with too much ambition and not enough discipline. They take the gusher of cash from their great high ROIC core business and, having run out of good ideas in their own industry, decide to venture into a completely unrelated business they know nothing about. The most famous example is Mobil Oil's acquisition of the retailer Montgomery Ward in the 1970s. What did an oil company know about running a department store? Absolutely nothing. The acquisition was a complete disaster, sucking up capital that could have been profitably reinvested in the oil business or returned to shareholders, and ultimately destroying immense value. Let's see how this plays out financially. Imagine three identical companies, each starting with $1 billion in earnings and a high ROIC. Each generates a significant amount of free cash flow every year. Company A's CEO is a master allocator. The company has ample opportunities to reinvest its cash at a high ROIC. It does so, and its earnings compound at 15% per year. Company B's CEO is also a great allocator, but recognizes her business has no more room to grow. So, she takes all the free cash flow each year and buys back 5% of the company's shares. The total earnings of the business don't grow, but the earnings per share grow at 5% per year. Company C's CEO is a hoarder. He takes all the free cash flow and lets it pile up on the balance sheet, earning 1%. After 10 years, the results are staggering. Company A will be an absolute behemoth, its earnings and stock price having multiplied many times over. Company B's stock price will have also increased significantly, as its earnings per share have steadily climbed. Company C's stock will have gone nowhere. The underlying business is the same size, but its growing pile of unproductive cash makes it a less and less attractive investment. The total shareholder return from Company A and B will have created massive wealth and capital gains for their owners. The return from Company C will have been pathetic. The only difference between them was not the quality of their initial business, but the quality of their capital allocation decisions, all of which should be driven by a relentless focus on the returns on invested capital. The final promise of this entire framework, the ultimate reason why a single number like return on invested capital matters so profoundly, lies in its direct connection to the most powerful force in the financial universe, the magic of compounding. A business that can consistently generate a high ROIC and has the opportunity to reinvest a significant portion of its earnings back into the business at that same high rate is not just a company. It is a compounding machine. It is an engine of wealth creation that over a long period can produce financial results that are almost beyond comprehension. The story of Microsoft in the 1980s and 1990s is the ultimate testament to this financial physics. It was a business with an almost perfect economic model for compounding. When Microsoft created the MS-DOS and later the Windows operating systems, they established one of the most dominant monopolies in business history. The beauty of their model was the economics of software. The initial investment to write the code was substantial. That was the invested capital. But once the code was written, the cost to produce one more copy was virtually zero. They could burn it onto a floppy disk or, later, allow it to be downloaded for pennies. Yet they could sell that copy for hundreds of dollars to computer manufacturers who had no choice but to install it on their machines. This created a business with an almost infinite return on incremental invested capital. Every new sale was almost pure profit. The company gushed cash on an unbelievable scale. Its ROIC was consistently north of 30%, 40%, even 50% in some years. This phenomenal profitability created a tidal wave of cash that had to be allocated. Microsoft used it to fuel massive research and development efforts, like the creation of the Office software suite, which built another incredibly profitable and high ROIC business line. It used the cash to build a fortress-like balance sheet with tens of billions of dollars, making it impervious to economic downturns or competitive threats. It used this financial strength to survive a bruising, decade-long antitrust battle with the U.S. government. And eventually, it used its cash geyser to begin returning enormous sums to shareholders through dividends and buybacks. An early investor in Microsoft who simply held on through this period would have seen their initial stake multiply thousands of times over. This wasn't just because they picked a growth stock. It was because they picked a business whose underlying economic engine, as measured by its ROIC, was so powerful that it was mathematically destined to compound wealth at a historic rate. The high ROIC was the fuel. The long time horizon was the runway. The result was the creation of immense, generational wealth and true financial freedom for its owners and early employees. The psychological principle that makes this so hard for many to grasp is that our brains are not wired to think exponentially, we think in linear terms. If something grows by 10% one year, we expect it to be just a little bit bigger the next. We fail to appreciate the explosive, accelerating nature of high-rate compounding. A business with a 30% ROIC that can reinvest all its earnings doesn't just grow, its growth rate accelerates. It's like a snowball rolling down a very long, steep hill. It starts small, but it picks up more snow with every rotation, getting bigger, faster. The power of compounding is a concept of faith for most investors. They know it's important, but they don't truly internalize its mathematical violence. Furthermore, a consistently high ROIC is not just a number. It is often the single best piece of evidence for the existence of a durable competitive advantage, or what Warren Buffett calls a moat. A company cannot sustain supernormal returns for long periods unless it has some sort of protection from competitors. In a purely competitive market, high profits would attract rivals, who would then compete those profits away. A company that can maintain a 25% ROIC year after year must have something special. A powerful brand like See's Candies, a patent or network effect like Microsoft's Windows, or a low-cost advantage like Geico Insurance. The high ROIC is the financial signal that a strong moat exists. And the moat is what protects the business, allowing that compounding machine to run for decades without interruption. The search for high ROIC companies is therefore synonymous with the search for great businesses with deep and wide moats. This brings us to a final, clarifying mental model, the sustainable growth rate formula. It's a simple but profound equation that ties everything together. A company's sustainable growth rate, the rate at which it can grow its earnings organically without taking on new debt or issuing new shares, is calculated as ROIC multiplied by its reinvestment rate. The reinvestment rate is simply the percentage of its earnings that it plows back into the business, the opposite of its dividend payout ratio. This formula reveals the two levers of value creation. To grow faster, a company must either increase its profitability, its ROIC, or it must reinvest a larger portion of its earnings. This is the mathematical core of corporate growth. An investor can use this formula to sanity check the growth projections made by Wall Street analysts or by the company's own management. If a company with a 10% ROIC that pays out half its earnings as dividends is promising 15% long-term growth, you know immediately that they are either lying or planning a risky, value-destroying acquisition. The math doesn't work. Their sustainable growth rate is only 5%, 10% ROIC asterisk 50% reinvestment rate. This simple formula is a powerful lie detector. It helps you avoid the trap of paying for a growth story that is mathematically impossible. The path of the 99% is to fall for these impossible stories. This is the essence of growth at any price investing. It is the belief that a company with a rapidly growing top line is always a good investment, regardless of the price you pay or, more importantly, the underlying profitability of that growth. This is what fuels bubbles. Investors see a stock that has doubled in a year, hear a fantastic story about a new technology that will change the world, and they buy, terrified of missing out. They don't ask about the ROIC, they don't ask about the path to profitability, they only see the rising stock price and the exciting narrative. We saw this with the dot-com stocks, and we see it in every cycle with a new group of story stocks. A recent example might be a meal kit delivery service. It might show incredible revenue growth as it spends a fortune on marketing to acquire new subscribers. The stock soars. But a look at the economics would show that the company was losing money on every single box it shipped. Its ROIC was massively negative. There was no moat. Competition was fierce. The business model was fundamentally broken. But for a time, the market didn't care. It was buying the growth story. Eventually, as always, gravity reasserts itself. The company runs out of money, the growth stalls, the narrative collapses, and the stock plummets 90% or more, wiping out the capital of everyone who chased the story instead of analyzing the business. Let's make the final, direct, financial connection. The ultimate value of any business is the sum of all the cash it will generate for its owners from now until Judgment Day, discounted back to the present. This is called a discounted cash flow, or DCF, valuation. Free cash flow is what's left over for owners after all expenses and necessary reinvestments in the business have been made. And the primary driver of a company's ability to generate free cash flow over the long term is its return on invested capital. Let's model it out. Company A has a high ROIC of 25%. Company B has a mediocre ROIC of 8%. Both start with the same level of revenue and profits. Over the next 20 years, both companies grow, but Company A, the high ROIC business, needs to reinvest far less of its profit to achieve that growth. It is a more efficient engine. As a result, it generates exponentially more free cash flow for its owners year after year. Company B, the capital-intensive, low ROIC business, has to reinvest almost all of its profits just to stay competitive, leaving very little free cash flow for its owners. When you project these two cash flow streams out over 2 decades and discount them back to the present, the intrinsic value of Company A will be massively, staggeringly higher than the intrinsic value of Company B. This is the mathematical proof. A high ROIC doesn't just mean a company is good. It means it is a superior generator of the one thing that ultimately determines its value and its stock price: cash. This is the bridge that connects one single number, a simple ratio, to decades of potential wealth creation, to the accumulation of life-changing capital gains, and to the ultimate goal of true and lasting financial freedom. You have just spent your valuable time and attention absorbing a framework that cuts through the noise of the market like a razor. You now possess the lens that Warren Buffett uses to separate economic royalty from the corporate peasants. You understand that the seductive story of growth can be a lie, a trap designed to part you from your capital. And you now have the tool to avoid that trap: the ability to calculate and interpret return on invested capital, the ultimate measure of a business's true profit power. This is not a trivial piece of knowledge. It is a fundamental shift in perspective, a mental model that, if applied consistently, can protect your portfolio and dramatically enhance your returns over a lifetime. You have moved from being a passive consumer of market narratives to an active analyst of business quality. But identifying a high ROIC business is only the first critical step. It tells you that you have found a powerful engine, a compounding machine. It does not, however, tell you if you are paying a fair price for it. And that is the second, equally important part of the equation. As Charlie Munger has said, a great company bought at a terrible price is a bad investment. The second critical piece of the puzzle is valuation, the discipline of determining what a great business is actually worth, so you can buy it with a margin of safety. Knowing you've found a Ferrari is one thing. Knowing not to pay the price of a private jet for it is another. The analysis of quality and the discipline of valuation are the two pillars that support the entire temple of intelligent, long-term investing. The video that is now appearing on your screen is the missing link. It is the second pillar. It takes the quality analysis you have just mastered and fuses it with the rigorous discipline of valuation. It is the bridge that connects the identification of a truly elite business to the practical act of buying it in a way that generates extraordinary returns. It is the next piece of the map, the link that connects everything you've learned here to the actionable process of building a portfolio of superstars. Most people will stop here, content with half the map, armed with only one of the two necessary tools. They'll find great companies and, in their excitement, overpay for them, muting their future returns. But for those of you who are serious about this journey, for those who see this not as a hobby but as the core strategy for building lasting wealth, the next step is not a choice. It is a necessity. The path from amateur to expert is not paved with single insights, but with a network of interconnected mental models. You have just forged a crucial link in that chain. The question is, will you complete it? Continue your ascent. Complete your mental arsenal. Click and continue your transformation from a speculator into a true capital allocator.